Shane Obata is portfolio manager at Middlefield Capital, and he joins us with his hot picks in tech. But to be clear, Shane, are you still owning NVIDIA?
Yeah, let's get that out of the way right away. Yes, definitely. I think we're doing a little bit of contra work today, contrarian work today, but the reality is in technology, the profits, the AI profits are still accruing to semis. That's the most simplistic way to look at it and the most true way. So this is not to say people should abandon their positions elsewhere. It's just we're trying to take a little bit of a contrarian approach given the incredible performance in semiconductors.
Well, I think that's great because, you know, it is getting kind of boring to just look at these stocks. So all-time high after all-time high. Let's find something that's a little bit under pressure. And you brought a few of those names. Adobe is interesting because for a while there, it was also being caught up in the AI frenzy because of its generative drawing capability, right, with Firefly. What happened?
I think Adobe was a name that was initially and perhaps still thought as an AI loser, right? I think when we think about content creation and design, now we've moved to image generation and video generation. So the alarmists are going to say, well, maybe this is going to put creative professionals out of business, but I think that's pretty far from the truth. So let's use ourselves for an example. If you give me an AI robot that can do all the creative stuff in the world, I'm not going to know what to tell it because I'm not as creative as a designer. And so that's a very simplistic way to look at it. But I think that the recent quarter for Adobe was good, especially relative to some of the other stuff we're seeing in software. And so I think they're starting to alleviate concerns that this is an AI loser, and perhaps they actually might be an AI winner as they integrate, as Firefly gets better and they integrate it into their suite of products.
I mean, let's also talk about the balance sheet here, not be dismissive of it. This is a company that's poised to generate $8 billion in free cash flow. A couple of years ago, it was half that.
Yeah, I think Adobe is kind of the poster child of, I think, where software companies want to be in terms of their free cash flow generation abilities and their margins and whatnot. So I think if we contrast this with Salesforce, right? Like if you looked at even big software companies years ago, the margins, especially, I don't think a lot of software investors will remove stock-based compensation and consider that. But even so, the margins were not that great. And so what you saw with Salesforce and the activism there was a bunch of investors said, wow, this is a pretty good business on the revenue side and the recurring nature of the business and the deep client relationships and the stickiness and all of that. But there's a lot more profitability to be eked out of this, right? Well, Adobe's already there. We're talking about a company that's got high 40s operating margins. As you noted, free cash flow generation has continued to increase. So this is a durable franchise. We think the fears around AI are overblown, like I said. And this is really what people should be looking for in software companies is durability and lasting power, really.
If you told me to guess where Motorola Solutions was trading, I wouldn't maybe automatically say it's at an all-time high, but it is. Of course, it's a very different beast than back in the day when it was the flip phone maker. So first of all, it's already run up. What's taken it there, and how much higher can it go?
I think multiple expansion has been part of the story here. So I think it's fair for investors to look forward and say, okay, maybe we shouldn't expect too much multiple expansion. I actually think too much more would be unhealthy, but this is a company that we think can generate high single-digit revenue growth for the foreseeable future, better than that on the EPS growth line. And it's basically, and I kind of like these hardware to software transition stories. So Motorola Solutions as it is now is still 75% approximately in land mobile radio, which is effectively radios for communications. And I would view it as kind of mission critical in nature, in the sense that EMS professionals and firemen and construction workers, but these businesses where there's a safety element and communication is really important. So that's kind of the core business. But as the company transitions away from, you can imagine these radios, that's hardware, right? There's supporting services and maintenance and whatnot behind that, but simplistically, that was the hardware part of the business. And now we're sort of moving away from that. And the growth areas are really in video and command center. So the video business is security cameras for governments, for education facilities, for different businesses, et cetera. And then we'll have in-car cameras for police officers, for example. We'll have body cameras also for enforcement agents and whatnot. So this is the really interesting part of the business, because I would compare, there's another company that we cover that I won't get into too much, but if you think about video and how data intensive video is, what that brings about is the necessity of having storage and the ability to, this is usually delivered by the cloud, the ability to store that data and to use it for evidence and all of that different stuff. So that supporting is what's driving the recurring part of this business. And we think that the growth areas are really interesting here, as public safety is going to remain a key theme, I think, especially in the developed world.
All right, I got to squeeze in the last one, the last minute that we have. Palo Alto Networks. This seems to be one that's falling because AI is rising, right? So everybody is willing to pay up for AI software, and Palo Alto in each of its quarters kind of suggests that maybe the growth rate isn't as robust as investors were hoping. Why are you buying the dips here?
I think one question we have to ask ourselves is, if we have a tech budget, are we sacrificing some of the software spending to go to hardware and semiconductors? I think the answer is probably yes. So you have to be careful and evaluate these companies on a case-by-case basis, but we know that cybersecurity is still top of mind for executives. It's, as businesses become more and more modern and data-driven and online, we have to protect IP and we have to protect customer data and whatnot. So this is a really good business. Part of the reason that it's slowed down is because they're moving to a platform model, where instead of selling you one product and then trying to sell you 2 and 3 and 4 and 5, they're trying to sell themselves as a platform. And I think that fits nicely into the theme of vendor consolidation, which is to say that I think everyone, consumers and businesses alike, are dealing with too many applications, too many software providers. So if I can, as a business that needs to protect, to make sure that I have good security for my network and I have good security for my internet browsing and all these other things, why would I not want to deal with one company? So I think Palo Alto Networks is positioning themselves as a platform company, and maybe there's some short-term headwinds around that, which we've seen reflected in the stock price, but I think it will pay dividends over the long term.
All right, Shane, we got to leave it there, but thanks so much. Great insight. And finally, something other than NVIDIA to think about. I appreciate it. That's Shane Obata joining us from Middlefield Capital.